The real reasons why Silicon Valley Bank collapsed and how did it happen. The Silicon Valley Bank, a bank known for lending money to some of the biggest technology startups, collapsed on Friday, resulting in a huge impact in the global markets. The collapse of the bank was caused by a sequence of events that began with the U.S. Federal Reserve raising interest rates to combat inflation, which made investors less willing to take risks. This, in turn, made it difficult for technology startups, the primary clients of Silicon Valley Bank, to attract investors. Some clients of the bank began to pull out their investments, causing the bank to look for ways to meet the withdrawals. To fund the redemptions, the bank sold a $21 billion bond portfolio at a loss, causing it to recognize a $1.8 billion loss, which it needed to fill through a capital raise. The bank then announced a stock sale to raise $2.25 billion in common equity and preferred convertible stock to fill its funding hole. However, the stock sale collapsed when some of the bank's clients pulled their money from the bank on the advice of venture capital firms. The collapse of the stock sale resulted in the bank going into receivership, with the Federal Deposit Insurance Corporation, FDIC, announcing that it would seek to sell the bank's assets and that future dividend payments may be made to uninsured depositors. The collapse of the bank was the biggest retail banking failure since the 2008 global financial crisis. SVB stated on its website on Friday, March 10, 2023, Silicon Valley Bank was closed by the California Department of Financial Protection and Innovation and the FDIC was named receiver. No advance notice is given to the public when a financial institution is closed. The FDIC has created the Deposit Insurance National Bank of Santa Clara, DNB, to facilitate the resolution of Silicon Valley Bank. To protect the depositors, the FDIC created the Deposit Insurance National Bank of Santa Clara, DNB, to allow depositors access to their insured deposits and time to open accounts at other insured institutions. SVB has experienced the largest bank failure since 2008, and the majority of its deposits were not insured. While insured depositors with up to $250,000 in their accounts will be able to access their money once the bank reopens on Monday under the control of the newly created Deposit Insurance National Bank of Santa Clara, it is unclear when those with deposits exceeding the insured amount will be able to access their money, or whether they will get all of it back. As SVB is a key bank for startups and other venture-backed companies, many firms could struggle to meet payroll and other obligations if their money is not quickly recovered. Investors and bankers across the globe are waiting for an announcement from U.S. regulators about what comes next.